Excellent. Thank you very much. Andy, are you out there?
I am.
Awesome. Hi, Andy.
How's it going?
Going good. It's a great morning.
It is. I'm up north right now by the lake, so it's pretty enjoyable.
Ah, that's awesome.
Yes, my name's Andy Gilbert. I'm with UHY LLP. I'm a principal there in our audit department, and I also spent 2 years as a CFO for a healthcare group. And I've essentially helped all my clients the last 3 weeks get the information ready to apply for these loans and get the information submitted to the bank. So I've been pretty much living and breathing this for the last 3 weeks.
Awesome. You're going to have a lot to add for us today. And then Ryan, where are you? There's a lot of people on my screen. I can't find you.
Yeah, I'm here.
There you are.
So my name is Ryan Howarth. I am a financial advisor. I broker through Prudential, one of the senior advisors at Prudential, but I also have a private office, and we run My Alpha Financial. My specialty amongst my team and at Prudential is portfolio architecture and wealth management.
Awesome. Thank you so much. You guys are all going to have so much to add today. I'm really excited for to ask you guys the questions that I have to get us going, and then excited to hear what everyone else has to ask today as well. So I would like to start with Jerry and Andy, because this is both of your areas of expertise. And I'd like to start out just alternating between the two of you, asking some very basic questions in kind of a rapid fire fashion to get people up to speed who aren't familiar with this main relief program that everybody's referring to as PPP. So if I can just alternate between the two of you. Jerry, first, can you tell us, what does PPP even stand for?
Well, it stands for Paycheck Protection Program.
Okay.
And by definition, that was the purpose of it, is to protect the paychecks for employees for an 8-week period.
Okay.
And that's how it was designed. It's a brand new program, never been done before. And basically not a lot of guidance on it. So.
Okay, yeah, that's what I've gathered. So real quick, by a show of hands, I just want to know how many people out there are familiar with this PPP program themselves? Okay, now some of you, I can't see your faces, but all right, perfect. So I think we're going to have a lot to add today. So I'm going to keep going with my questions because I'm not at all familiar with it. So this will help some of you who aren't, and hopefully we'll gear up some questions that you might have. So Andy, can you tell us who qualifies for PPP?
Yeah, really any business that's negatively impacted by COVID-19 qualifies for the PPP loan. And even if you don't have employees, sole proprietorships or single member LLCs also qualify based on their net income. So.
Okay, excellent. And Jerry, what does the application process look like, super briefly? And does an accountant have to do it for you, or can you do it on your own?
The application itself is basically from the SBA, which is the Small Business Administration, which is a government agency. However, all the lending is performed through banks. And
Okay.
So some of the banks actually have tweaked the application a little bit, but for the most part, it's a straightforward application. There's some general questions as to whether you have criminal background, whether you're behind in child support. That's basically for the owners. And then after that, it's basically a one box. You fill in what your average payroll is, and that's pretty much it. It's basically straightforward.
Okay, so they make it easy.
It must go
for
through
you.
a bank. It has to go through a qualified SBA lender, which is basically most chartered federal banks.
Okay, excellent. And Andy, what can this be used for?
So the way it was set up was the majority of it needs to be used for payroll to keep your employees on your payroll. So you get paid on 2.5 times your average monthly payroll. So you get 8 weeks to use the funds, and payroll for the next 8 weeks is used. And then you can also use it for rent, mortgage interest, utilities, and stuff like that too.
Okay, excellent. And just to be clear, so you have to keep everyone on payroll in order to receive the funds?
Not to receive the funds, you can still lay people off, but in order to get the loan forgiveness, which we'll talk about in a little bit, you need to keep similar headcount and a similar payroll level as you did last year.
Okay, so that was my next question actually for Jerry, is it true that it is forgivable?
Yes, if you meet the terms of the loan, provisions, it is forgivable, which basically means you have 8 weeks from the date you receive your funding to spend that money on, well, 75% of it has to be spent on payroll. The other 25% could be spent on what Andy referred to as utilities, mortgage interest. And so it would be forgivable, but that's a separate part of the process,
Okay.
which you have to make an application for it to be forgiven.
Okay, excellent. So Andy, you already answered my next question, so I'm going to ask you a different one. So if it is not going to be forgivable, what is the repayment program look like? When does it have to be repaid by? What does that look like?
The way it's set up, it's a 2-year note with a 6-month deferral. So you have 6 months of no payments, and then you're required to pay the remaining balance off over 18 months at 1% interest.
Okay, okay. So Jerry, this might be kind of the same thing, but what is the time frame for PPP and how long will it run for? You guys are saying 8 weeks here?
Well, and the monies have to be spent by June 30th of 2020.
Okay.
So you receive your funding, you have 8 weeks, but it's also limited by June 30th, which may come into play with the second phase of the
Okay.
PPP.
So yeah, so the first phase has been paid out, correct, Andy?
Yeah, it's been totally exhausted.
Okay, and how many businesses did receive the funding out of, those who requested it?
Well, a total of about 1.2 million businesses throughout the country received their funding, which
Okay.
sounds like a great number, but unfortunately, there's 30 million small businesses in the entire country, so a very small portion did receive it.
Okay.
In the application process, based on my client base, probably 65 to 70% that applied received the money,
Okay.
and the other 30% didn't because either funds were exhausted or some of the banks weren't ready in time to get the applications in.
Okay. So Jerry, why did some businesses get approved and others did not? Now, Andy just kind of mentioned that it may be on the banks, but is there any other factors that they took into consideration with the applications?
I got the impression most of the banks, it was relationship driven. If you were a current customer of the bank, it was easier for you to get towards the front of the line, so to speak, because some of the banks were requiring if you weren't a customer, you had to at least open up an account, which is a little difficult under the current conditions. So my overall opinion would be is strictly if you were already a current customer, you probably were approved quicker than if you had to establish a relationship with the lender.
Okay, that makes sense. So Andy, what issues does the PPP pose?
Really, the only issue I see is everyone who needs the money getting it. As I said before, only 1.2 million businesses received the loan through the first phase, and there's going to be a lot of companies that don't get the funding, because they didn't learn about the process soon enough, didn't have the wherewithal to actually make the application and do the work to get the money in. So that's the biggest issue I see, is there'll be a lot of unhappy business owners who don't get the funds, even after phase 2 rolls out next week.
Okay, absolutely. So Jerry, how will the PPP be governed?
Well, overall, it is a small business administration program. However, the funding was directed through the banks. So I believe the application for forgiveness will go to your lender, and they'll require whatever documentation they need to establish that you use the funds for the purpose of the loan, which was for the payroll, utilities, and interest.
Okay.
That's a separate part of it. And I'm sure there'll be some further clarification as to what the SBA is looking for in specific documentation.
Okay, excellent. So Andy, is there any risk for a business to receive this PPP?
Not really, no. The only risk would be is if you didn't really need the money and you took it anyway. There's been a lot of bad press. I think it was Steak and Shake that received funding and then didn't need it and ended up getting the money back. It'd be bigger companies like that getting bad press. On the application, you have to certify that you were actually negatively impacted by this and need the money.
Okay.
But right now, if you think about 1.2 million loans going through, it's really hard for the SBA to govern who really needed the money and who didn't. So the risk level's low.
Yeah, they're moving as fast as they can, I'm sure. So Jerry, we mentioned that there is a phase 2, that it was approved this week. What amount is approved for phase 2? What are we looking at here?
Phase 2 was approved to 310 billion. Phase 1 was 350 billion. So on the surface, it's obviously almost equal. There appears to, the original estimate was that it would take 600 billion to replace the payroll for the small businesses. And I think that's what they tried to do, but it seems to me that I'm not sure where that 600 billion figure came from, but I don't believe it's going to be sufficient for every business to qualify.
Yeah, that makes sense. If only 1.2 million received the first round and they're about the same amount this round, that's not going to get us to the 30 million businesses. So Andy, what does the process for phase 2 look like? Is it the same as phase 1 for the most part?
Yep, exactly the same, just a lot faster paced. There's a lot of applications out there that were submitted when the funds dried up in phase 1. So all those people that were in line are still in line for phase 2. So the process is the same. In my opinion, it'll dry up a lot faster. What was it, 3 weeks for the first round? If not less, it'll probably be 4 or 5 days, in my opinion, that these next round of monies will dry up.
Okay. Now, Jerry, if you didn't already have an application in for, say, phase 1, and now phase 2 is happening, and you're just putting an application in, do you have a chance?
Well, I guess there's always a chance, and I wouldn't recommend not doing it, just in case there may be a phase 3, so at least you're in line. But as Andy said, there was a lot of applications that were queued up and were not approved because the funding ran out. And most of the lenders are saying that they will handle those first with this second round. So hard to say because only the lenders really know what the volume is, but I think it's significant.
Okay. So Andy, I don't want to get too deep into this right now, but can you just really quickly explain the EIDL?
Yeah, so EIDL is the Economic Injury Development Loan. That was the SBA loan that was set up prior to the PPP being set up. Wasn't as much money allocated to it. You could only get $2 million as opposed to $10 million into the PPP, and it didn't have the forgiveness factor in it. So the money had to be paid back to the government over, I think it was 20 years at 4% interest or something like that. So it was still money from the government, but there was no forgiveness piece to it.
Okay.
And those funds dried up as well with the PPP funds. So those are part of the new phase 2 coming out as well. More allocation to that. I think another 60.
It's 60. It's
okay.
60.
Okay, that's helpful. Every little bit counts, right? So Jerry, I want to go ahead and elaborate on this. I want to flip sides a little bit. So how do you think the PPP and this EIDL are going to affect our economy, our government right now? Go ahead and elaborate as much as you want.
Well, it's obviously the PPP was a brand new program, never been done before, and how it's going to affect the government. Obviously, on the surface, between that and the stimulus checks, you were talking a $2 trillion worth of funding provided by the federal government. So obviously, that's additional debt that has to be considered. And what kind of went unnoticed, there was another $4 trillion that actually was funded into the United States Treasury that went directly to the Federal Reserve to backstop the financial system. So that's also creating an interesting impact because the Federal Reserve has been buying a lot of these high yield bonds. A lot of the ETFs that were freezing up because bonds aren't as liquid were bought by the Federal Reserve. So you basically have the Federal Reserve backstopping most of the financial system in this country right now, which is also unprecedented. So it's going to be interesting to see how it plays out.
Absolutely. Hey, Tom or Danny, I want to get you guys in on this question. Do you have anything to add on this state of the economy or the housing markets in response to the PPP? What do you see? Either of you, I'm sure, would have a great idea.
For sure. I mean, I'm sure we can both chime in on it. What Jerry just said, to me, that just brought inflation into my mind, right? So I believe the federal government and the Federal Reserve stepping in and doing everything that they're doing to make sure that our economy doesn't come to a complete screeching halt and into a very deep depression, that should lead to future inflation, in my opinion. But knowing that it's going to happen in the future, there's things that can be done to help protect against that inflation. But, if everyone's retirement accounts just kept free falling and their businesses are stopping, obviously that would have led to disaster for a lot of people. So in my opinion, they've done a phenomenal job just pretty much halting things. And we've seen a strong rebound in the equity markets. We'll see, right? There's not much time left for a V-shaped recovery to happen. If it's going to happen and fully get back to where it was, it needs to quick. But regardless, we're well off the lows. We'll see if we retest them again. But long story short, the government's done what they've needed to help stop the bleeding, in my opinion.
Okay. Tom, do you have anything to add?
I mean, not much. You covered everything. I think it's, not too dissimilar from 08 and 09. It's just, you inject a ton of money into the system. And the one thing that is curious about that is, where is, we talk about inflation, but where is it right now? Where is it hiding? Because we were supposed to see inflation after 08 and 09 when all of that liquidity was dumped into the market. But rates have remained very low. So although I do agree with Danny, we have conversations about this all the time. I know inflation's out there somewhere. It's hiding somewhere. It's lurking. I don't know, but will we really see high inflation in the near term? I don't know. I have no idea. We thought that in 08 and we didn't. So it's curious that oil is so low, because I think that gives inflation a lot of room to move too once it starts moving. But any economists out there, please hop on and let us know, where is this inflation lurking at? Because I do think that's a very important thing. Like when rates go up, that's going to definitely change the market again.
Absolutely.
Sure.
Danny, were you going to say something?
Yeah, just like it's just so interesting out there though, because oil turned negative for a brief period this week, and just looking at the largest oil companies in the world, they've actually had a decent week if you nibbled into them at all over the last several days. So I don't know, it's just wild. But Jerry, you mentioned the ETFs. So if they did not step in and basically freeze those, would those ETFs have all gone to zero? And do you think that'll create future risk for using ETFs as a part of your portfolio as opposed to buying individual stocks?
Well, I'll answer briefly, but it's probably a better question for Ryan. But
Probably is a better question for Ryan.
Yeah, I think what would have happened, because it was on the bond funds and those are not as liquid as equities. So you would have had the situation where people were trying to redeem and couldn't, which obviously creates panic. And so I think that's what they were trying to avoid. But as far as ETFs, we'll let Ryan handle that portion of it. So,
Excellent.
Ryan?
So, sorry, I was trying to unmute myself. So, the difference between like an ETF stock and a mutual fund is just the level of diversity you're going to get. Buying a single stock, you're going to have all your eggs in one basket. ETFs are passive investments where you're going to be buying an index or a grouping of stocks that follow the same asset class. And then a mutual fund is going to be an actively managed portfolio that you're not really going to know what you hold because it's traded every day. Billions of dollars have left managed or actively managed funds like mutual funds over the last decade because passive investments have shown better performance. And personally, that's the only thing that I use as fee-based planning with my clients because the cost is so much lower. You're getting a broader form of diversification in the fund. So, when it comes to ETFs over a stock, I would most likely use that for long-term planning. If you're looking for short-term gains, like somebody just mentioned, like the oil crisis that we just briefly went through, stocks are good in that and for estate planning because we still have the step up. But ETFs for a broad diversification for long-term goals are what I believe are the best option to use.
Sure. Ryan, without going like too far into this, because I'm sure Janae, there's a ton of questions here. Do you believe there's a false sense of security in the equity markets right now? I mean, the VIX dropped 13% yesterday. Do you believe it's real stability showing in the markets, or do you think it's artificial?
Well, it's still a little artificial. You got to remember right now, everything's being played on emotions. And if you look at the last 2 years where we've broke through that typical bull market length of 7 or 8 years, which is on average what we see, anytime there was any negative news, you saw a huge decline. So if you go back to February of 18, we had that flash crash, which in one day the market dropped over 1,700 points down on a Monday, and it rebounded, to like 1,400 points down by the close. That's going to be the new norm going forward, just because of how high our market is. Right now, I definitely think, and a lot of analysts think that we've already been in a recession, but that false sense of security in the equity markets is there. But we're also seeing that a lot of the factors like interest rates are keeping that, we're keeping that stable with our low GDP. We've changed our game plan in regards to economic forecasts. Before, the U.S. wanted to try and get like 4 or 6% GDP, where now we've dialed that back to like around 2 to 2.5 with a low interest rate market. And that sustains a long-term equity bull market, which is where we saw this 10-year bull market come from in the last decade. For all intents and purposes, we have a lot of positive news coming out from the coronavirus and cases going down, countries reopening economies. So all that positive news is going to relate to positive growth in the equities. One thing that I would caution is we still haven't seen the actual economics come out of this. So those won't come out until June, July, or August. And that's when we actually are thinking that we may revisit the lows or close to it, what we already saw. But this has all been self-inflicted. We turned the light switch off on our economy. This wasn't fraudulent like we saw back in 07 and 08. And this wasn't essentially fraud through the 01 tech bubble, where you were evaluating companies that really didn't have the earnings to back it up, and there were like pump and dump schemes going on. So this was just all self-inflicted, and once we turn the light switch back on, we'll creep back to our norm, but it's going to take a while, and that will affect the equity markets.
So you're projecting, Ryan, you think we might see more of like a W-shaped recovery then, correct? So we bottomed out, we've seen healthy recovery. You think we may test those lows again before we actually fully recover?
Absolutely. Most times that we have a big pullback in the market and we visit bear market territories, we have a false rally within it. And I think this definitely is something that is possible more times than not, what we're seeing, just because everything is just off the positive news of the coronavirus getting back on track. But the economics behind it haven't been released. You saw earnings come out in the last few weeks that have just been poor for the companies, and they really haven't shaken the equity markets, which is odd. But when there's a drop in oil, and again, those are futures contracts that were affected mainly because of storage. We don't have storage for oil right now, so nobody wants to buy oil. And if you're buying a futures contract, that means you're going to be buying it for X dollars through the next month. So if you don't have anywhere to store it, they want to make it in value, or basically have zero value, because you don't want to buy it. You need somebody to pay you to take it because you can't store it. So it's going to go to waste. So like with oil, you saw a huge pullback in the market just in those few days because of that negative news. And I think that's showing the true position of the equity market right now. Is when hard economic factors come out, that's going to happen, and we're going to see some more sharp declines. But volatility in the market, 200, 300, 400 point swings up and down are going to be the norm for the next 18 months.
Well, those few 100-point swings now seem like nothing, because we were used to 1,500-point swings every single day for 12, 13 trading days in a row?
Yeah. And
that was intense.
But you got to think, that was when we started turning the light switch off on the economy, right? Now, I like to look at it as one of those old school Edison light bulbs, where if you turn it off, it immediately goes dark. And if you let it sit for a few hours, it's still dark, but right when you turn it back on, it becomes a slow glow, and it takes a while for it to get fully bright. But we're continuing to do that with the economy. It's going to take a lot longer. It's not going to be as much of a V-shaped market. That's my little guy running around. But So if you have the market drops so steeply, most likely we're going to see like an L-shaped market where it dropped straight down, but it's going to have like a very slow recovery up. But again, this is most likely a false rally, and I'm positioning my clients for that. If you want to have money work right now, you can put money in the market, but you got to be careful because you're going to have to restructure that in the next few months. Most likely you're going to have a better buying opportunity in the next few months.
For sure. Or if you're going long right now, pull some profits off the table, or have a UVXY hedge or something along those lines to help protect for the downside.
Yeah, one thing that you really want to, it just depends on what type of account, how old you are. Anything that's retirement based is meant for retirement, so you got to keep that in mind. Restructuring into better propositions of value is very smart right now, and you can get it at a pretty good discount. And from there, that's just going to benefit you in the long term. Now, short term, if you have short term cash accounts, you have to be really careful because cash is going to be realized. So if you had positions that you had long term gains on, that you want to start harvesting some of those at a lower amount, maybe your income's going to be affected, so that tax bracket might go down. Those are all things to consider. But that's all going to be individual based and account based, depending on what you're going to do. But you got to remember that with interest rates as low as they are, the bond market and the fixed income market par values have gone up dramatically. So if you look at like the 20-year Treasury ETF, that's up about 37% year to date. So that's a bond that's up in value 37%. That's a floor that you've created once interest rates normalize. So you have to be careful with that so that you're not restructuring or going into bonds or any kind of fixed income that you think is going to be a safe haven and generate a little bit of income. Because when the interest rates do normalize, that's just a floor that you've created for yourself in loss.
For sure. Ryan, could you drop your contact information in the chat bar just in case anyone has specific questions? Because this conversation on this topic could go on for quite a long time. You can go ahead and grab the floor back.
Yeah, I definitely will.
Thank you, Ryan. I appreciate it. You actually answered like the 5 initial questions that I had for you. So thank you very much. We have a lot of questions in the chat right now, and I still have some questions I want to ask about the PPP, but let's get started with the questions from you guys because I think we've sparked enough conversation here. We got a lot going on. The first question, I want to throw this one to Andy, and it's from Tom Lauer, and he says, besides the PPP, what other SBA loans should we be considering?
Yeah, so the other one is the EIDL that I mentioned earlier. Again, not as lucrative as the PPP, but it's still an option that's out there. Definitely the most lucrative SBA option out there right now is the PPP with the forgiveness piece.
Okay, excellent. And then I have another question on the PPP. This is from Thomas. I'm going to throw this one to Jerry. His question is, can the PPP also be used to pay for healthcare benefits?
Yes, that's part of the definition of payroll. It includes healthcare benefits, the employer retirement contributions, like a 401k match, and it also includes the state and local taxes on unemployment, which would be the MESC. So there are a few other things included in the definition of payroll that can be used and paid and then be forgiven as part of the loan.
Okay, excellent. I'm just going to keep firing through these because we have a lot of them that came in. Andy, this question is from Eric Phillips. His question is, what if you don't use the full 75%?
So I think this is, so let's say you get $100,000 and under the forgiveness portion of the loan program, you have to use $75,000 of that for payroll, and the remaining $25,000 can be used for other qualifying costs. If you deviate away from that 75% percentage and use, let's say, 85%, essentially the differential is going to be termed out and owed over the 18-month period once your 6-month deferral's up.
Okay. So Jerry, question, this is just a username, so I'm not sure who this one came from, but are retirement plans or IRAs for the owner factored in the loan or the application process?
Well, the retirement contributions, to the extent they're employer paid, are part of the payroll calculation. Now, as far as again, those all would relate to the employer provided portion of it. So I guess I'm not fully understanding the question, other than if it's a 401k match or any type of pension plan or profit sharing plan, that would be included in the definition of payroll. And that's also true. There is a limit that only the first 100,000 of compensation is eligible as part of the PPP, but the retirement portion and the health insurance as it relates to the 100,000 is also included. So you technically can be over 100,000. The 100,000 is just the payroll portion.
And Jerry, on that 100,000, just to clarify, that is prorated, correct?
That is correct.
So it's not 100 grand truly. It's
really
divided out over those 8 weeks.
Yeah.
Right?
Well, yeah, 100,000.
I think it's 15 grand,
12,
right?
It's 100,000 divided by 12 times 2.
Right.
So
Thank you.
All right.
So this question is actually a real estate question that came in, and I'm going to throw this one to Danny. Question is, what are the projections of the rental market?
The rental market should remain strong and continue to actually, like if you're a landlord, your rental amounts that you're able to get each month should remain very strong. It should actually go up. Unfortunately, there's going to be people that put in tough spots where they're forced to rent over the next several years because they're not available to, they don't have the ability to take advantage of these programs for whatever reason, or they just miss out. There's going to be people that are forced to rent homes. As a landlord, though, you're going to be able to find people that are really strong tenants and just got stuck, in a spot, which again, just like the last time we had a recession, it was completely different circumstances, but there were very good tenants out there in the market. The rental market absolutely boomed. So your investment property should remain very strong and continue to have high demand for the foreseeable future.
Okay, excellent. That's promising. Andy, question from Eric Phillips. For the second phase, are they simply going to continue processing loans that were in the queue from the first round?
Yeah, so essentially the way it was set up, it was a first in, first out basis. So if you got your loan in day one, you're supposed to be the one who got your loan proceeds day one. So everyone who was in the queue who didn't get funds is still in the queue, essentially in the same spot, if you will, they were with their bank. And when the loan process opens up again, they're going to start back where they left off and continue through the process.
Okay. So I'm just going to ask a follow-up question on that that came in. What advice do you have for a business that didn't get round one money? Is there anything they can do to improve their chances for round two?
Unfortunately, there's not. I mean, the application needs to be in. If the application isn't in, I would get it in ASAP. But yeah, like I said, it's a first in, first out basis. So once your application's in, you get put in a line, and when your turn's up, you get your funds. So there's really no way to improve your chances. It's just where you are in the queue.
Okay, and there's no need to reapply.
No, you.
Okay.
It's still in line, yeah.
Okay, so Ryan, this next question, switching gears a little bit, this one's for you, came from Tom Lauer. What are you telling clients that are in the market with retirement funds? Are you predicting a recession? How does that look? And where is a safe place to put my money right now?
So I typed out a brief response, but in regards to the market and talking with clients, retirement funds are meant for retirement. So you have to have that long-term perspective. And again, that's going to be dependent on age. So this is a really good time to restructure. Look at positions that have been overvalued, that have really came down, and you can buy those at a deep discount. If you have the ability to get into tech, tech is going to be a very strong sector in the market for years to come, mainly because the way that we're going to do business going forward is going to be a lot of technology based, just like we're doing today. So getting into tech is still going to be a main driver of the market, just like it was the last bull market. So if that's an ability of yours within a 401k, or if you have an advisor or investment account, that's what I would be overweighting and continuing to, just because that's going to be the main driver. But in regards to recession, you got to think for recessions aren't very long. It only takes 2 quarters, so you got to think half a year of a decline in GDP and some other economic factors like rise in unemployment during that quarter. So 2 consecutive quarters, and we're technically in a recession. For what we've done, most likely we're going to technically be in a recession. It's just how quickly are we going to swing out of it? Typically, that's 8 to 18 months on average. So a lot of the things that we have, I think just because it's been self-inflicted, it's actually going to help us in the long run because it's going to take us through very quickly. In regards to where to put money that's safe, you got to think if you're going to hold cash right now, cash is a great place to put money if you want to buy in with it or you need it for liquidity purposes because the volatility in every sector of the market right now is quite high. So if you're doing short-term investing, then you're going to want to look at some tech areas, some oil, some commodities. If you're going to want to look for long-term investing, it's again going to be tech, a lot of the value positions in large cap within the U.S. Short-term, you got to have it in cash because you can't put anything just because of the volatility. So holding cash either for purchases or for liquidity purposes is going to be king for the next probably 6 to 8 months.
Okay, excellent. So Kevin DiVirgilio also asked a question very similar. Kevin, can you give us a thumbs up if that answers your question that you had as well? Where is he? Oh, thumbs up. All right, cool. Awesome. Thank you. So next question I have here is from Elizabeth McKenna. I'm going to throw this one to Jerry. And her question is, will the money that was given back by the businesses that didn't need it from phase 1, will that money be rolled into phase 2 or will that be paid out separately?
No, it's been rolled back into the program. And
Okay.
so essentially it probably will end up as part of phase 2 only because those applications are now being processed.
Okay. Excellent. This is switching gears a little bit. This one's a good one for Tom. This is a great question from Denise Mansfield. Her question is, how does the mortgage underwriting, let me start over. How does the mortgage underwriting process look at temporarily displacement from employment or temp unemployment? How does this impact your interest rates or process for refis or new mortgages? Can you explain all of that for us?
Sure. Yeah, it's actually kind of an easy answer. So you're asking how lenders are going to view basically temporary income in the form of, unemployment basically. And the simple answer is they don't consider that as income at all. It's not a sustainable payment that lasts into the future. And there's actually a pretty short finite end to it. So it's just, somebody got furloughed or became unemployed, we can't use any of their income for the loan application process. Obviously, that's not going to change anybody's interest rate. Rates aren't going to change based on that. But the fact that you probably could get approved 2 months ago and now you're furloughed, you can't be approved now. Especially, I know there's a lot of real estate agents on here. That's why it's a great time to reach out to your clients and just ask them the question, how, we were looking at houses before, what's going on now? Did you keep your job or did you have to get unemployment? Because if somebody was in the process before and was pre-approved and now they've lost their job, it's going to be impactful at time of application. So unemployment pay is not considered as income for a mortgage.
Okay. Thank you, Tom. Appreciate that response. Andy, I have a question from Cynthia Hunter, and the question is, I filled out the application for the SBA. Do I need to fill out an application at the bank too?
So I think when she says the application to the SBA, I think she applied for the EIDL loan, the original one that came out first.
Okay.
So the answer is, yeah, if you're going to try to get the PPP loan, that's a separate application you do through your bank. A lot of them are set up online, where you can just log into your business banking account online and apply right there. If you've already applied for the EIDL and you also apply for the PPP, the EIDL funds just get refinanced into the PPP. So there's no issues there. But I think what she did was apply for the first loan, and yeah, you should apply for this second one as well through your bank.
Okay. Excellent. Thank you. So I don't have any new questions here in the chat, but Danny says, throw us a tech nugget. So Danny, what are you looking for here? Can you?
So yeah, just Ryan, like in the tech sector, just curious, like what's your favorite long-term buy right now that you believe is a strong value right now that has great upside potential? And then even if you have a speculative play that you'd throw out there, if you could just give us a quick two, that'd be great.
Yes. Well, so like the speculative, I'll stay away from, just because usually when we're talking about speculative, we're going into some of like the small mid caps.
Yeah, I'm just trying to make things interesting.
Yeah, well, we're just in general, I'm staying away from all those, because those are going to be the ones that are going to be hurt the most during this time. Just the reason we're having small business talks right now. But there's a couple. There's US Tech, which is the tickers IYW, and then there's World Information Tech, which is FTIC or FTC. Those are two ETFs that have performed phenomenally. And in regards to my portfolio, overall, the total money that I manage right now is probably down. I think it's just under 6% year to date, where the rest of the market's down about 16. So if you look at that from a large cap perspective, we bought in at the low into those positions where they had lost a great deal, and we had restructured some of our fixed income or other positions into those, and then they rose pretty quickly outside of the big drop. So those are areas that I definitely believe strongly, and they've really performed over a great deal. So in my background, just so everybody knows, with portfolio architecture, I'm one of the lead portfolio architects at Prudential, top 100 rep in the country every year in regards to all the factors that they look at. And then beyond that, Prudential has structured portfolios that are already designed by Vanguard, Russell, Brinker Capital. Prudential just started and launched their own. And for 4 years running, I've outperformed them by at least a 25% margin for 4 years. So those are all areas that we look to be very strong in. But again, I believe in sector investing, long-term perspective, and then we really trim the fat when it comes to certain portfolios, like getting out of small mid cap at the time being. And we trimmed international years ago. Hey, buddy. So that's what we do. So he gets really excited about talking about trimming the fat. So.
That's great. Awesome. Thank you. So does anybody have any other questions regarding the PPP, or want to share anything about their experience that they've had recently?
Tommy.
Yeah.
You're passionate about this.
If you're friends with Tommy on Facebook.
So one of the things that you're passionate about, I know, is like, so the big banks looked like cruise ships out on the ocean, and the small banks, credit unions, looked like speedboats doing laps around them. And you are super passionate about that. So
yeah, it's really pushed me. I mean, it's really pushed me to reconsider the banking relationships I have with at least one of our businesses, just because it is the fact. I think they're referring to a Facebook post I put out there, and it wasn't negative. It was just a question. It was survey for all the business owners out there who got PPP money. And that turned into a really long conversation with a ton of great feedback. And what I found, I think there was like about 150 different people that commented on that post. And kind of what I could string together through all the responses were that the credit unions and the small banks destroyed the big banks when it came to getting the amount of their clients actually approved with funds. Not on a volume perspective, but on like a per client basis. It looked like the community banks far outperformed the big banks.
Yeah, to add to that, Tommy, I mean, yeah, I made the comment with the Facebook post. I thought it was funny, but I mean, your thoughts were the same thoughts of half my clients who were frustrated with the big banks who couldn't get the ball rolling on this process. And you get banks that have 6 employees up in the thumb that are processing 50 loans a day.
So here's my question, guys. Do you think round 2, the big banks will redeem themselves because they got absolutely embarrassed in round 1? Do you think that in round 2, they will perform at a higher level? or do you think the small banks are going to win round 2 again? Because that's a big question that, like, if you're a small business right now, it's tough, right? If you have relationships with both, which direction do you go?
You a small bank. I can't tell you to go to a big bank with what I've seen. I mean, if you read Cranes, you've seen, one of the biggest banks in Michigan just got destroyed the last 2 weeks. And their application process is up and running. They're saying they're going to be taking stuff and taking monies in, but who knows? I mean, I've been hearing that for 2 weeks. So if anyone were to ask me where they should go, to a small credit union or community bank or to a big bank, I would tell them community bank all day long.
But it's kind of like it's too late now, right? In my opinion. Yeah. I mean, our application is in with our big bank, and even though we didn't get, funding on round 1, hopefully we're still in line, and hopefully we get round 2. It's just, it's like I'm with the big bank and I pay their fees, and because they are more expensive, right? These big banks, when you look at your statement, you're getting charged a hell of a lot more from a big bank than you would from a community bank. So you ask yourself, why? Right? Why do you do that? Well, it's because of these types of relationships and these types of programs, and you would hope that your bankers can take care of you in time of need. And just didn't see that with the big banks. So, but now it's
and you think of the bigger banks too, banking with them, they're supposed to have more purchasing power, right? They give you better rates, they can give you better options because they're the big bank. So when we get into this process and they weren't able to do anything, it was actually very surprising to me.
Yeah,
definitely. I want to throw Jerry one last question here. It's kind of switching gears here, but he has a lot of experience in this. So I want to maybe answer some questions that some of you may be thinking. So Jerry has, and I might explain this wrong, but he's had many years of experience within the field of insurance damages. Can you tell us a little bit more about that, and if there's any options for businesses out there right now?
Well, I assume your question is directed, do they have insurance coverage for their lost profits or their business interruption due to this virus? The general response is probably not. The insurance industry, there's a consulting group that puts out what's called FCS, and they indicated your insurance contract usually is triggered by what's called physical damage. You have a fire, you have windstorm, hail, a hurricane hits. So they indicated they feel the virus, just because you could wipe it off, it does not cause physical damage. And so it seems, and I've had calls from agents asking the same question, you have to look to what's called your declarations page, your deck page, which is the first 3 or 4 pages of your policy. It's possible you could have a sub-coverage, which is called civil authority, or there's another sub-coverage called ingress-egress, which covers a business if the traffic is restricted to your location because of the government. Those coverages, unfortunately, are rare in small business policies. You typically will see them in larger risks like hotels or malls or those types of things. So unfortunately, that may be the only place you could find coverage. But again, it can never hurt to call your agent. And actually, I would always recommend it never hurts throwing in a claim too, because the worst that'll happen is it gets denied, and it probably won't go against your premium costs. So it can't hurt. So.
Okay, excellent. Well, thank you very much. I don't have any other questions. If any of you have questions, I'd like to start to direct you one-on-one to our panelists. So I think we had some really great topics covered today, a lot of great questions. I definitely hope this was very insightful for all of you. Want to give a big thank you. If we can all unmute real quick and give our panelists a round today. Thank you guys.
Thank you guys.
Thank you guys all for tuning in and for participating to keep the conversation going. If all of our panelists can just throw your contact information in the chat real quick, so that if anybody has follow-up questions or looking to talk one-on-one with one of you about their personal situation or whatever, they can feel free to reach out to you. Or if anybody needs anything on my end, if you send an email to at mirealteam.com. I'll be happy to direct you to the right person. I did record this today and we'll post it on our YouTube channel later. So if anybody wants to reference it at any point, you're welcome to do that. But we really appreciate all of you. And if there's anything that we can do to help support you, your business, your family, please ask. You know, we want to help our community through this and we all want to come out on top together. So thank you all again and have a great day.
Thank you, Janae.
Thank you guys.
Oh, well.